President.
Senator from Ohio.
Thanks, President. I thank the Majority Leader for recognizing me last week. Mr. President, last week the Senate gave tax handouts to millionaires and billionaires and multinational corporations that ship jobs overseas. The middle class got almost nothing. This week, it's the bank's turn. And just like last week, working people get ignored again. The bill the Senate Banking Committee will take up tomorrow, S-2155, puts taxpayers at risk of another bank bailout and puts homeowners at risk of the same traps that led to the foreclosure crisis, all while, again, virtually doing virtually nothing for hardworking Americans. While Congress has been preoccupied doing the bidding of special interest lobbyists, American families started getting notices in the mail that their children's health insurance program, that their CHIP insurance will be yanked away. 209,000 children in my state, the sons and daughters of low-income workers making $8, $10, $12, $15 an hour who don't have insurance. The CHIP program started bipartisanly and always having been bipartisanly enacted and renewed over the last 20 years. The CHIP program will be yanked away. Virginia will be next. Then Ohio and other states where parents will go to their mailbox, open up a letter from the government saying, sorry, your children's health insurance is gone. The Senate is doing nothing to stop it. Instead, this body made up of senators who have insurance paid for by taxpayers, this body devotes its energy to helping banks of all sizes that are making record profits. The third quarter of this year, the 5 largest U.S. banks, just the 5 largest U.S. banks, raked in a combined $21 billion in profits. 5 banks, the third quarter only, $21 billion in profits. In fact, profits at the 5 biggest banks are even higher than they were before the crisis. Meanwhile, working Americans haven't gotten a raise in 16 years. I sat at my high school reunion in Mansfield, Ohio about a year ago with a woman who's been a teller at a large bank for 30 years. Her income after 30 years at this bank is $30,000 a year, working for one of those largest 5 banks. Yet those banks, as I said, $21 billion in profit in the third quarter. 44 million Americans are saddled with student loan debt. Communities are littered with abandoned homes and hollowed-out factories. Yet this bill has no help for Americans burdened with student loan debt, no help for homeowners still underwater, no help for workers who haven't had a raise in years. Congress, especially the Banking Committee, have a collective amnesia about the financial crisis. It's like it didn't even happen 10 years ago, and a collective amnesia about the housing crisis and the devastation it brought to families across the country. We know how many people lost jobs 10 years ago because of Wall Street overreach. We know how many people lost their savings. We know how many people lost their homes. Families in Ohio don't have the luxury of this collective amnesia. Families don't have the luxury in my neighborhood of forgetting what happened 10 years ago because so many of them are still digging out. We passed dodd-frank Wall Street reform legislation to protect those families, make sure a crisis like we saw 9 years ago doesn't happen again. Stress tests were put in place to ensure that banks can weather the next downturn without putting the economy at risk. Stress tests, according to the President's designee to be chair of the Federal Reserve, and according to so many others who understand these issues and understand banking, stress tests are one of the most effective tools we have to prevent taxpayers from being asked once again to bail out the banks. This bill, Mr. President, weakens stress tests for all large banks, banks that together took $239 billion, that's 239,000 billion, $239,000 million in taxpayer bailouts last time. Banks like JP Morgan Chase, other Wall Street mega banks that are designated as global systemically important banks. We call them GSIBs around here, meaning their collapse could cause harm that ripples around throughout the world, not just the damage it does to Main Street in Oklahoma City or Tulsa or Cleveland or Toledo, but that would do damage to the economy all over the world. Without rigorous annual stress tests, taxpayers could once again be on the hook if those too big to fail banks collapse, and we don't have the right tools in place to see it coming. So I ask my fellow senators, are you really willing to go back to your homes? Are you willing to go back to your states and tell taxpayers you work for that you're willing to gamble another $240 billion of their money on a bill like this? For some other large banks, those stress tests could be even easier under this bill. Make no mistake, these aren't small banks we're talking about. Together, and I'm not talking about the largest 10 banks here, I'm talking about the banks in more detail affected by this bill. Together, these banks, about 30 of them, hold $4 trillion in combined assets. That's $4,000 billion in combined assets. That's more than a quarter of all assets across the entire banking industry. Would you trust your family's health to a doctor who only passed a dumbed-down version of her board exams? Why would we trust the health of our economy to banks that only pass diluted, weakened stress tests? This bill doesn't stop at stress tests. It allows these same large banks to once again borrow more money than they can afford by weakening capital requirements. It exempts dozens of the largest banks from making plans called living wills. These are plans that make sure that if a bank fails, taxpayers won't be paying the bills once again. It weakens oversight of foreign mega banks operating in the U.S., the same banks that have repeatedly violated U.S. laws. Let's run through a few of their rap sheets. Santander, I believe, is a Spanish bank. It illegally repossessed cars from members of the military, our military. It repossessed cars from our servicemen and women who were serving our country overseas. We're giving them a break. We're going to deregulate them. Deutsche Bank manipulated the benchmark interest rates used to set borrowers' mortgages. Barclays manipulated electric energy prices in the western U.S. Credit Suisse illegally did business with Iran. UBS sold toxic mortgage-backed securities. So we're going to give these banks a break. They've repeatedly violated U.S. law. We're going to give, these are banks we want to help, Mr. President. The bill also puts American homeowners at risk of the same sorts of mortgage abuses that brought us the foreclosure crisis. My wife and I live in Cleveland, Ohio, in zip code 44105. In first half of 2007, my zip code had more foreclosures than any zip code in the United States of America. It's pretty hard for most of us to imagine here what it might be like to be kicked out of our homes. I asked my colleagues to try for a minute to put yourselves in the shoes of one of these families. Pope Francis exhorted his parish priests to go out and smell like the flock. Go out and listen to people. See the kinds of lives. Ask them questions about the kinds of lives they live. So what happens when a family's thrown out of its house? First, before you're thrown out, you give up the family pet to try to save money, even though that dog may have been your son or daughter. My son and my grandson and granddaughter just got a little stray that their father had been out jogging and picked up a little dog that it's only been a week and a half, and they love this beautiful little dog. So families give up the pet to try to save money. Well, that's not enough. You sit the kids down, you have to tell them you're moving. They'll have to change schools. Mom won't be around as much because mom's got a second job. These are the impossible decisions and painful conversations millions of Americans were forced to have in 2007, in 2008, in 2009 because of bank greed, the big banks' greed, and their, in some cases, illegal activity. Trillions of dollars of housing wealth were destroyed. African American and Hispanic families lost more than half of their accumulated wealth that they still have not fully recovered. We can't go back there. These stakes are too high. That's why some of the provisions in this bill are so troubling. Let me run through a few of them. This bill permits mortgages for homes up to $400,000 in some areas to be offered without an appraisal to verify the home is worth what you're paying. Without an appraisal, you know what would happen, Mr. President. You could end up in an underwater mortgage on day one. It no longer requires banks to set up accounts that help you budget for your property tax and homeowners insurance. Instead of manageable payments built into your monthly mortgage, you could end up with an unexpected tax bill at the end of the year. You could end up with an unexpected insurance bill at the end of the year. You can't pay, and then the foreclosure proceedings start. It allows some banks to sell you an adjustable rate mortgage without the bank assuming any responsibility for whether you can afford your payments once the initial rate expires. People don't always know what it means with an adjustable rate mortgage. It might be in the small print. We know forced arbitration's in the small print too, Mr. President. We know how that works out. Say you're a customer in Youngstown. You could take out a mortgage at 4%. Say your payment's $400 a month. After 3 years, your interest rate jumps to 9%. So your monthly payment is all of a sudden almost $700. Your bank knows you can't afford that. The bank knew it when it sold you the mortgage, or it should have known. That's the bank's job. That's the law today. It's not the law under this bill. Under this bill, when your mortgage suddenly spikes, when you have to start having these tough conversations around the dinner table with your partner, with your children, the bank that sold you the mortgage is protected. It gets off scot-free. Today, you could go to a judge and fight to stay in your home. You might not be able to under this bill. What's fair about that? Because this bill blocks some homeowners from going to court to stop banks that foreclosed on them. Sound familiar? Not that long ago, Vice President Pence came to the Senate floor to sit in the chair that the senator from Oklahoma is sitting in, came to the floor late at night to stop customers like those 140 million cheated by Equifax and several million cheated by Wells Fargo, came to the floor late at night to stop customers from having their day in court. You know, when the vice president shows up in this body to break a tie, Wall Street wins every single time. Now this bill blocks homeowners from having their day in court. It's the context under which we will consider this bill. American families, American taxpayers who stand to lose the most get almost nothing. No help with student debt, no help with underwater mortgages. But they're being told, we're hearing consumers being told, don't worry, trust us, trust us. The Trump administration regulators will make sure everything is just fine. Trust us. Trust people like Vice President Pence, who cast the tie-breaking vote to strip consumers from their day in court. Trust Treasury Secretary Mnuchin, whose former bank made a fortune kicking families, including veterans, including people in the Army and the Marines, and seniors out of their homes, has now merged into a new bank that gets relief under this bill. And trust Secretary Mnuchin's colleague at that same foreclosure machine, Joseph Otting, now leading the Office of the Comptroller of the Currency, the financial watchdog in charge of overseeing the national banks. Think about that. Trust him. And trust Mick Mulvaney, installed as the new part-time head of the Consumer Financial Protection Bureau, despite what the law says, whose first action on the job was to stop payments to veterans, to seniors, to consumers, to stop payments to people who had been cheated by banks. These payments were on their way. The banks had been found guilty of cheating their customers. Mick Mulvaney, in his first action as head of the Consumer Bureau, stopped those payments. Trust Randy Quarles, the new head of bank supervision at the Federal Reserve Board, who was a Treasury official in the years leading up to the crisis and who said on the eve of the financial crisis, fundamentally the economy is strong, the financial sector is healthy, our future looks bright. He was in the Treasury Department in a highly placed job in the Bush administration as the economy started to implode. That was his observation of the state of housing. That was his observation of the state of the economy. He's now head of bank supervision at the Federal Reserve. This track record is what taxpayers and homeowners are supposed to trust. This is the track record that gives senators the confidence to take a gamble with taxpayer dollars. These guys are going to protect us from another crisis or prevent another bailout. I don't know about my colleagues. I'll tell you that when I'm home in Ohio, when my friend from Delaware is at home in Wilmington, I meet a lot of people who feel invisible. Entire communities feel invisible. They feel used, they feel abused, They feel some other things I can't say on the Senate floor, by banks, by mega corporations, by Wall Street, and yes, by Washington and by this U.S. Senate. Too often, they are right. They are being used and abused by banks and by mega corporations and by Wall Street and by people in this body. We have a chance to show these people we see them, we hear them, we work for them, we will do our jobs and fight for them. We do that by blocking this bill. Mr. President, as I conclude, I want to say something about some people that are affected by this bill that makes sense. Regional community banks provide critical services to customers and homeowners and small business. I respect my colleagues' desires to support them. I, too, support efforts to help community and regional banks fill important needs. I don't support efforts to roll back accountability measures on the largest banks with nothing to help hardworking Americans who have the most to lose. It's this simple. If we want to help the middle class, let's help the middle class. We sat here day after, well, the last couple of weeks, both in the Finance Committee and on the floor on the tax bill, and I heard just ad nauseum my colleagues say, this tax bill is for the middle class. Well, it really wasn't for the middle class. If you want to cut taxes for the middle class, you cut taxes for the middle class. Well, the same here. If we want to help the middle class, let's help the middle class. Whether it's the tax code or our banking laws, you don't grow our economy by handing out more money to people at the top. Whether it's Wall Street banks, whether it's large corporations that outsource jobs, you don't do handouts to the wealthiest people as sort of a bank shot. Get rid of the middleman. If you want to help the middle class, darn it, help the middle class. Don't filter it through the largest banks and the largest corporations, hoping some of it will trickle down. We grow our economy by putting money directly in the pockets of middle-class families. So let's cut the corporate middleman. Let's throw out the Wall Street lobbyists. Let's provide relief for student loan debt and mortgages and community banks. Let's help workers who haven't seen a raise in over a decade. Let's show the people of this country that we actually do, in fact, work for them. I yield the floor.
Senator from Delaware.
Mr. President, I rise this evening to speak to the tax bill that passed this chamber. Forgive me. Mr. President, can I ask consent to speak for up to 10 minutes?
Without objection. Senator from Delaware is recognized.
Thank you. Mr. President, when we were last here together, it was roughly 2 a.m. Saturday morning, as this chamber took up and passed by a very